Hello and welcome to Moneycontrol. You have tuned into IPO Watch and I'm your host Nickey Mirchandani. We're here to talk about DOMS industry, which is opened up for subscription today. And of course, as we speak, the issue has already been subscribed. More interest coming in from the retail category. The price band of this issue has been fixed in the range of 750 to 790 per share. It's a 1200 crore offering. Much of it is coming in from the OFS, and of course fresh issue too is to an extent of 350 odd crore. But to know more about the company's financials, its strategy and the unique business proposition, we're being joined by Santosh Raveshia, who is the managing director of the company, and the CFO Rahul Shah is here in the studio with us. Afternoon there, gentlemen. Let's start off with what do you actually make out of, it's been a good journey thus far in terms of the financials, but now that out of the 350 crore that you're going to be raising in from the fresh issue, how are you going to be commissioning in? Much of it is going to be utilized towards the new plant, right?
Yes.
So now with the utilization already sitting at that 85-90% level, where is the growth going to be coming in from till the time the new plant is commissioned?
First of all, Nickey, good afternoon. Thank you for having us here. So basically, just to give you a broad idea, DOMS, since the last few years, we've been in a continuous sort of a capex cycle. In the last 3 years itself, we've already invested close to about 175 odd crores on capital expenditure. As we speak, there are additional facilities coming up in our existing manufacturing infrastructure. Plus, wherever possible, we are upgrading our molds, our machineries, as well as doing debottlenecking. So this will basically take care of the immediate growth. In terms of capital expenditure, like you said, we are doing this fresh issue. Almost about there is a project that we are going to launch. 450 crores of total investment. We've acquired the land. Another 380 crores still to be invested, out of which 280 crores will come from the fresh issue, and the rest 100 crores would be from the internal accruals. And so historically, if you see, we've always, whenever we've made investment, we've tried to achieve a gross fixed asset turnover of 3x, which is something which we'll like to continue with. And in terms of this new project, we feel, construction will start from January 24, and in the next 12 odd months, we'll have the first building up and running, and eventually the entire project will get over by March 26. But we'll have, commissioning part by part, where we plan to have 4 manufacturing buildings in this project.
So what's the kind of rate that would sustain at this level? Because the main concern that comes in that you've plotted in growth, next is what, right? Your future plans essentially, because the utilization is sitting at a good level. It doesn't look like more scope to expand there. New plants will take time to kickstart the production. So where the growth is coming in from?
So like I mentioned, there are plants which are already being constructed. 100,000 square feet of plant for writing instruments already started. This started in FY24, the first half. Just to guide you about the numbers, in first half which we closed, our revenues was about 760 crores. So there is growth which is coming in. Plus there are a lot of manufacturing infrastructure additions that are happening in terms of new machines, new mold in the existing infrastructure. What we are talking about, the capex plan from the IPO issue, it's for the completely a new project, a greenfield investment. So capacity enhancement will come from the existing plant as well.
So Mr. Shah, just talking about your revenue growth in that case, from 2022 to 2023, the number is almost double.
Right.
Right? 683 crore, it's almost come to 1200 crore that we're looking at for 2023. First 6 months, the number that you highlighted was roughly in the range of 760 crore. If you were to analyze this number, 15 crore is doable in that case in terms of this financial year?
So ma'am, the high growth you see in FY23 was result of 2 factors. One was the base year was impacted because of COVID. FY21, FY22 were 2 years which were impacted because of COVID. Educational institutions were, almost shut. Things then normalized. FY23, we saw that normalization impact. Plus there was an impact, a lot of pent-up demand. Because of which we were able to achieve such a large percentage in terms of growth. But like we said, FY23 is like a normalized year. we believe this trajectory to keep continuing.
So 1,1200 to 1,400 crore is what we can look at in this financial year if we're supposed to normalize your FY23 numbers.
So considering there are certain restrictions in terms of giving guidance.
Is your second half better than your first half?
No, for us it's always been more or less similar. There's no seasonality that we see in our business.
Okay.
Capacity addition is something which drives revenue growth for us rather than any seasonality, I could say.
Okay, so 1,500 crore looks like a doable number given the annualization and lack of seasonality that you're talking about from the little comments that I could gather. But do you think pencil industry is on decline similar as pens owing to the shift towards digital learning?
So basically what we've experienced across these years, if you talk about 10 years down the line, there was an consumption of slate and pencils, those chalk pencils.
Right.
Now the entire shift has been to the normal wooden pencils. So basically what we have been experiencing is that because of basic education becoming very important for our country as well, I think pencil as a tool is becoming very important, and we've been demonstrating our through this through our numbers as well. So pencil as a category looks very interesting, still very much preferred by kids and also office goers, for their usage. So pencil looks promising.
Pencil looks promising. Okay, all right. What are your inorganic growth plans that it forms a key part of your strategy? What's next for the company? Have you identified some projects, some companies where you could build on to the scale?
So basically, if we understand the DNA of DOMS, it has grown more through partnerships. So whether it is partnership between Raveshia and Rajani family, further followed with Fila family.
Right.
So when we wanted to enter into a category like paper stationery, we were able to enter with the support of Pioneer Stationery acquisition, where we today have 51% in that particular company, and we were able to. So when we entered this company, I would like to say that in 2015 it was a 4 crore revenue company. 2023 we have done around 138 crore from that particular business only in 7 years. So we feel that there are a lot of opportunities aligned. We just have had a very small participation of around 30% equity in a toy company which is Clapjoy Innovation. So this is again within our consumer spectrum, and we feel that anything which is interesting within the kids and within our target consumer, we would love to explore.
So what makes you invest in a toy company? What's the growth outlook there? More businesses that you think you can diversify perhaps into?
So basically, as I said, we have a distribution channel of around 100 plus super stockists today, around 4,000 plus distributors and 120,000 retail touch points. And what we have felt that toys is something which is very closer to what we are doing. So we have certain products like hobby and craft, and what we feel that toy again complements a lot to our business because it's more of to the kids growing pattern. So this is the reason why we've entered in toys. It's for now it's an understanding. It's more from the understanding of business, how much it can complement to our network and to our business strategies as well. So I'm not ready to say much on what will be happening on toys, but yes, it's an interesting category for today when it comes to India.
What percent of your revenue comes from this segment?
So it's very minuscule. So it's I can say it's not even gaugeable. It's a acquisition which is recently done. This company used to sell its toys mainly on e-com platform. With our distribution channel, we have just started helping them to reach out to the general trade of India.
You see that growing by what percent, say by in the next 2025, if that's the number that we're looking at? What percent contributor to your revenue?
So what we've been always very much aspired is that we should focus on having a better market share. So similarly for toys, we aspire to look at gradually bringing ourselves, on that particular shelf of market share. As of now, I cannot, we are just a beginner. It's more sort of a startup.
But a 5%, 2% revenue, if you can put a number to that, just
no,
to
no,
give some sense of direction of why the acquisition and what kind of projections.
Nickey ji, it's a very small company. We've invested, around 1.5 crore in this business. So you can imagine, the size and scale of this business right now. But yes, I would like to say that it's an interesting business. We would love to scale this business going forward and make sure that we try to be a remarkable player in this particular field.
Now for toys, next is what?
So, Nickey ji, anything which resonates with our TG target group, which is kids, we would love to explore. So we're just looking out at if there are certain opportunities which will come in future.
Like that's why the areas of interest, perhaps anything that you think right now is piques your interest.
So Nickey ji, as you know that we have a very robust plan of entering into this writing instrument space. Again, it's a space which is I can say which is filled of a lot of opportunities. So we are right now getting up ourselves. The entire team is onboarded on this particular project. So once we are online and in line with this particular project of writing instruments, we'll have another streams always within the pipeline, and we'll for sure come back to you on what we are thinking about the other lines.
The reason why I'm asking this question is most of your peers have diversified into bottles and consumer wear. You think that's also the road that you'd like to take?
Nickey ji, for us, it's very important to retain the philosophy of our founders. My father, late Sri Raveshia, and my uncle, late Sri Manubhai Rajani. So they had very clear philosophy about the company that we should always focus on our tier group, which is kids. So anything which is relevant to kids and young adults, we would be available there. We would not allow to follow, any unusual product lines which we are not good at. So we understand child psychology to the fullest, and we would love to cater this particular TG well.
Okay, talk about your geographical mix in that case. 21% comes from exports, and 78 or 79 roughly comes from domestic. Do you see that mix changing anytime soon? And if yes, what are the growth levers?
So basically, today around 70+% of our revenues contributes from general trade. I would like to say here that this particular general trade has been built up through this years with a lot of hard work, a lot of passion, and a lot of personalization. So what we would like to focus is that our first priority would always be general trade and Indian domestic requirements. Of course, export is always very interesting to explore, and we are there. But for us, the immediate priority is to cater to the overgrowing demand of our domestic trade.
So the mix remains the same.
The mix remains almost remain same. A delta of a little will always be instrumental.
In the favor of?
Maybe sometimes export could grow a little.
Where the margins are accretive?
So we are balanced. So we are more focused on operating margins, and we make sure that our operating margins across our categories and across our channels are similar. Also, I would like to highlight one very important thing here. DOMS is probably one of the finest regional balanced player across the sets. So basically, if you look at DOMS presence in North, our revenue contribution is about 32%. Because North has a larger population base, we are at 32% there. Followed with West at 30%. Followed with South at around 19-20%, and followed with East with the same rationals. So it's purely a very balanced regional player, pan-India player, you can say.
Sure. So just coming back to the margin profile, how much of this do you think 15% was achieved and clocked in at 2023? Do you expect the margins to normalize now at 15%, or you think there is a scope of further growth? And if yes, what are the levers?
So what we have always believed that we always follow a very sustainable margin policy. Of course, we never shy with making margins. As our 2023 EBITDA margins were around 15.4%. You'll observe that in H1 our EBITDA margin has raised by little to 16.7%. So we are on our wings on making a margin little by little, but we always say that nothing at the cost of market and nothing at the cost of margin. So we are right now more focusing on market share achievement. For us, every year is very important to achieve more market share. And
so 15% sustains in that case, perhaps outperform also.
I can say that yes, we are.
Give us a range. 15 to 20% is. You think it's achievable?
We believe 15 to 17% is something what we would want to focus on.
The also reason why I asked you about exports was the fact that the opportunity to increase exports to FILA Group companies under China Plus One strategy. The reason why I asked you about the change of mix was that. Do you see any tailwinds coming from that?
So Nickey ji, I would like to share here that we together, FILA and us, have been working on this China Plus One strategy since we have partnered, I think. And we have made it sure that we have been taking fullest advantage of that until now. Of course, as our domestic priorities are always been taken on as a first layer, but our presence across the international geographies are also not ignorable. So FILA contributes around 11% of our export numbers, and DOMS through its direct channels contributes to around 8% of the revenues. We are with FILA, we are present across their different geographies, and with DOMS we are present across Middle East, Southeast Asia, and also the neighboring countries.
One big concern that most of the brokerages across have flagged when it comes to this IPO. Sure, I mean the IPO has been subscribed, but the only bone of contention for them is high dependence on FILA Group. Sure, the number of concentration has come down from 69% to 61%, but is more of dependence and rather just to say diversification and offing?
So basically, FILA, as I said, FILA Group is our strategic partner and also a corporate promoter. FILA and us have been, the relationship between us has been very symbiotic. And which has resulted to today a very win-win situation. Right now we both the families are only focused and concentrated on how we can maybe take advantage of the strengths today DOMS has got in terms of R&D, in terms of manufacturing. This is the only point of view we both the families have today to discuss. And
so no reduction in the percent is coming down from FILA Group.
So as of now they were at 51%, but with this offer for sale they will be at around 30+%, but still they are one of the single largest shareholder on the cap table.
And they'll continue to be at 30%.
And also continue to be promoter of the company.
Yeah, because 60% of your exports come in from that group, right? Of the 20% basket that you have, 60% comes.
Yes.
Do you intend to reduce that percent anytime soon?
No, absolutely not.
Okay. The other last question that I have for you is talk about your business moat, unique business proposition as they call it, and also what explains your lower margins as compared to other peers like Link, Flair Writing. They command across margins of 35 to 40 odd percent, maybe in surplus of 37% of what you've clocked in. A, what explains the lower gross margins, and B, unique business proposition.
So Nickey ji, I will take your last question first.
Okay.
Basically, when it's about margin, we are operating in around 7+ categories today, and for us it's very important to focus more on achieving more market share. Each and every category has its own opportunities. So for us, when we take the decision making of what margins are we going to make, it's very important for us also to balance it with what market share we are going to take ahead. So as we discussed, we've grown from 8% of market share to 12% of market share, and we would love to continue doing this for our brand. Of course, as a unique proposition, I can say we are a company with the fullest production participation in place. So all the products which comes from DOMS is all been produced at DOMS. This is what is strength about DOMS. And also this production happens with a lot of backward integration. Also with highest level of R&D, where we have around 50 plus team of R&D having their pipeline of products to launch ahead. So what we strongly believe that we are not a catalog company. We are a very serious player here to be, and we'll continue being very serious ahead.
All right, gentlemen, we'll just gonna leave it at that. And thank you so much for taking out the time and joining us here in the studios. And congratulations again, your issue has been fully subscribed. Much of the category interest comes in from the retail community. But with this, it's a wrap. Just to sum this up, priority on domestic market, operates in 7 plus categories, margins to remain in 15 to 16%. Revenue would be in the range of 1500 odd crore in this financial year, given the commentary that we've had. But with this, it's a wrap, and goodbye from all of us. Thank you so much for watching.